What is the Heiken Ashi technique? The Heiken Ashi technique averages price data to create a Japanese candlestick chart that filters out market noise. Heiken Ashi charts, developed by Munehisa Homa in the 1700s, share some characteristics with standard candlestick charts but differ based on the values used to create each candle. Instead of using the open, high, low, and close like standard candlestick charts, the Heiken Ashi technique uses a modified formula based on 2-period averages. This gives the chart a smoother appearance, making it easier to spot trends and reversals, but also obscures gaps in some price data. The Heiken Ashi candle has been created as a technical trend trading indicator for MetaTrader 4 users. This indicator makes the use of the popular trend indicator Heiken Ashi more convenient for newbie traders. Besides forex currency pairs, Heiken Ashi candle is also capable to generate correct trend signals on stock, commodities, and crypto charts. This indicator appears as a suitable tool for analyzing market trends on MTF charts. Traders can apply it on any timeframes from 1 minute to daily charts of the MT4 platforms. Therefore, you can focus on both scalping and intraday trading at the same time by using a single trend indicator. Furthermore, this indicator delivers real-time trend signals that help you to assess potential buy-sell setups at the key swing areas of the price. As a result, it lets you focus on breakouts and swing trading opportunities even in a range-bound market situation. According to our review, it works well as a solo indicator but can be added to any trend-based forex trading strategy for upgrading trading plans. How to determine buy-sell opportunities using the Heiken Ashi candle trend signal. What is the Heiken Ashi technique? The Heiken Ashi technique is a Japanese candlestick-based technical trading tool that uses candlestick charts to represent and visualize market price data. It is used to identify market trend signals and forecast price movements. The Heiken Ashi method uses average price data that helps to filter out market noise. The absence of market noise results in a clear illustration of market trends and direction, which helps determine potential price movements. The trading technique assists traders in identifying when they should hold on to a trade, pause a trade, or identify if a reversal is about to occur. Traders can adjust their positions accordingly, i.e., either avoid making losses or lock in a profit on the chosen position. Heiken Ashi charts look like typical candlestick charts, but they smooth out price action because their bars are computed out of price ranges rather than every tick movement. The Heiken Ashi technique is designed to filter out market noise and provide a clear picture of the prevailing conditions in the market. Traders can read price action by watching candlestick types or patterns when using normal candlestick charts. When using the Heiken Ashi technique, traders can accurately determine trends when a valid trend is in the market and when it pauses or is likely to reverse. The technique can help traders decide whether they should stay in the market or exit the trade. Munehisa Homa introduced Heiken Ashi in the 1700s, the same individual that also created the typical Japanese candlestick charts. The formula and calculation for Heiken Ashi candles. Normal candlesticks include information, open, close, high, and low prices. Heiken Ashi candlesticks also use these values, including information from previous periods. Here is the formula for calculating Heiken Ashi candles. Open. The open of a Heiken Ashi candle is the midpoint of the previous candle. Open equals open of previous candle plus close of previous candle / 2 close. The close of a Heiken Ashi candle is the average price of the current period. Close equals open plus close plus high plus close / 4 high. The high of a Heiken Ashi candle is the maximum price reached during the current time. High equals maximum price reached. Low. The low of a Heiken Ashi candle is the minimum price reached during the current time period. Heiken Ashi candles look like the regular Japanese candlesticks. Read this to learn about the regular candlesticks. However, there is a big difference between them. In regular candlesticks, each candlestick is independent and has no relation with the previous and next candlesticks. Each regular candlestick represents 4 prices: open, high, low and close, but Heiken Ashi candles are like moving averages to eliminate the price noise. Indeed, Heiken Ashi candles eliminate lots of noise and create some delays, and so most traders think that they are good for novice traders who haven't become disciplined enough to wait for a strong trade setup to get in the markets. I will tell you if they are right or not. In Heiken Ashi candles, the open price is the average of the open and close prices of the previous candlestick. It means, the system or the trading platform, be it MT4, MT5 or all other platforms that support Heiken Ashi, they use the regular candlesticks data to plot the Heiken Ashi candles, or I'd better to say they use the same timeframes open, close, high and low prices that are used to plot the regular candlesticks on the charts, to plot the Heiken Ashi candles. When the open price of a candle is the average of the open and close prices of the previous candlestick, it eliminates some of the price fluctuations noises. However, this is not all the story. The close price of a Heiken Ashi candle is the average of the open, close, high and low prices of the previous candlestick. It means, the close price is even more smoothed. The high price of a Heikin-Ashi candle is chosen from one of the high, open and close prices the previous candlestick that is larger than others, and the low price of a Heikin-Ashi candle is chosen from the previous candlestick's low, open and close prices that is the small.